All right, guys, bang, bang. We've got Darius here. Darius, global liquidity, we have been talking about it now for weeks. It looks like we have finally bottomed, but the recovery is not so much a linear thing, or is it? How do you look at the global liquidity right now?
Yeah, hey man, what's up? It's good to see you guys. So I'll start by saying we've had a significant increase off the lows in global liquidity. If you show up chart number one, what I'm showing in this first chart is our global liquidity proxy. That's the blue line in the top panel. For those who are maybe not unfamiliar, how we track global liquidity at 42 Macro, we aggregate the U.S. dollar sum of the global central bank balance sheet, global broad money supply, and global FX reserves minus gold. For a variety of different reasons, we include those measures. But the one thing we'd say is if you look at the middle panel there where we show the max drawdown study for the blue line, which again is our global liquidity proxy, it recovered significantly off the lows of late 2024, 2022. But as you can see in recent weeks and months, that recovery process has really stalled out and we're actually moving in the wrong direction. So this is something we've been calling out in our research. We started making noise about this in the late April, right around the year-to-date highs in Bitcoin, and we've not recovered that price. We've obviously haven't really crashed lower, but in our view, a lot of what's kind of weighed on the price of Bitcoin and really all digital assets relative to like U.S. equities is the fact that we've seen this nonlinear recovery process in global liquidity.
So when you start looking at asset markets, obviously these asset markets are a key piece to it. There's kind of the response to the liquidity, if you will. How are you looking at asset markets and what is that response?
Yeah, great question. So the next chart we have for the viewers, we have our global liquidity proxy in the top panel with respect to the S&P 500's price and the Bitcoin price. And what we show in the kind of the second, third, and fourth panels there is a trailing 1 year Z-score study. So we're normalizing these measures to kind of make them a little bit more comparable. And what you see is that if you look at a 1 year Z-score of our global liquidity proxy, it's only at about a 0.2 sigma relative to its trailing 1 year mean. Whereas the S&P 500 is a plus 2.2 sigma, and Bitcoin's a plus 1.1 sigma. So we're seeing a bigger recovery on a normalized basis in asset markets relative to the recovery we've seen in global liquidity, which again is now moving in the wrong direction.
So when we start looking at global liquidity impulse, that is something kind of a little bit different. You're gonna have to explain to people what exactly the impulse component is, and then what are you seeing there?
Yeah, absolutely. So just a simplistic, we use big jargony words in finance, but the reality is all we're tracking is trailing 3-month momentum in these time series to identify whether the impulse is positive or not. You can obviously pick your own duration, but we try to track the trailing 3 months seems to be the best in terms of fitting this with asset markets. And so as we show again, our global liquidity proxy in the top panel of this chart relative to world equity market cap. And as you can see, we're kind of flat trailing 3-month basis, and global liquidity had been very positive, right? If you go back to the lows of, had been very negative, then it became very positive. Now we're kind of flat. And so if you go back to the lows of 2022 last year, we had a minus $6 trillion trailing 3-month impulse in the month of October, and that's obviously it's a pretty significant decline. But that kind of swung all the way around to a plus $9 trillion-ish impulse, positive impulse, by the time we got into Q1 of this year. And that positive impulse has been steadily waning on a trailing 3-month basis until we got to kind of April and May, which is now flat. So this is not, the equity markets sort of mirror this from the perspective of the momentum in the impulse itself, so the momentum of the momentum. But the reality is we're still growing in equity market terms, and which is not necessarily something that we feel is sustainable.
Now, one of the nuances when we start looking at this is there's public sector and private sector liquidity, and sometimes they move in kind of concert with each other. Other times they do not. Right now, it appears they're not. So explain the differences between public sector and private sector, and then why are they almost operating at the opposite ends of the spectrum right now?
Yeah, absolutely. So I'll start by saying the reason we look at global liquidity in terms of our global liquidity proxy, again, central bank balance sheet, global broad money supply, global FX reserves minus gold, is to sort of identify, inflection points in the liquidity cycle by isolating, kind of key factors. So private sector liquidity, which is liquidity created by commercial banks, tends to be very pro-cyclical. If growth's accelerating, liquidity is going to be accelerating. If growth's decelerating, liquidity is going to be decelerating. Banks effectively extend credit. Non-bank, financial market participants extend credit when things are getting better. They pull back on credit intermediation when things are getting worse. So we understand that this is a very key component of liquidity, private sector liquidity, in terms of exacerbating trends. But what causes the trends to inflect is the public sector liquidity function, i.e. central banks, what's happening with respect to central bank policy. So that's why we spend so much time talking about central banks as market participants, because ultimately they can cause an inflection either to the upside from a negative trend or an inflection to the downside from a positive trend with respect to private sector liquidity, and then obviously broad liquidity when you amalgamate all these measures. And so right now what's happening, we're seeing a modest increase in private sector liquidity on a trailing 3-month momentum basis. Again, that's the bottom panels in these charts. And then when you see we're also seeing a negative trailing 3-month impulse in global private sector liquidity. So the private sector liquidity impulse is very much kind of mirroring the slowdown. We have a recession in the Eurozone economy. We have a disappointing recovery in the Chinese economy that's kind of inflected negatively from an impulse perspective in recent months, in the most recent month. And then obviously growth has been slowing in the U.S., although albeit still very much not in a recession. So that's kind of one thing we call out. But again, don't forget, the global liquidity impulse trailing 3-month is flat. It's flattish. It's moving lower on a kind of a sequential basis. And ultimately, we expect that kind of trailing 3-month impulse to get that flat trailing 3-month impulse to go negative in the coming months.
So let's go around the world here. We can go east to west. Let's start with China and kind of the liquidity there. What are you seeing?
Yeah, absolutely. So China is kind of bucking the trend as it relates to global liquidity. So right now, the Chinese liquidity impulse, that's chart 5 there, is actually currently negative, only modestly negative. But they've done a series of measures in recent weeks that gives us confidence to say that modest negative impulse is likely to inflect positive in the coming months. So they cut their 7-day, their benchmark 7-day reverse repurchase rate by 10 basis points. The PBOC did last week. They also cut their 1-year medium-term lending facility rate by 10 basis points last week. We've seen follow through by Chinese banks this week. They're cutting their 1-year and 5-year loan prime rates by 10 basis points. And, this kind of mirrors the series of easing measures we saw kind of in the middle to second half of 2022 that really helped the Chinese liquidity impulse kind of inflect positively, alongside obviously a lot of PBOC open market operations and medium-term lending financing itself. And so that's something we would expect to see over the coming months. And obviously would be a positive from a global liquidity perspective, given how dominant the Chinese economy is in that matrix. But the issue there is that you have liquidity impulses in the U.S. is likely to deepen. The negative liquidity impulse in the U.S. is likely to deepen in the coming months. Eurozone is likely to inflect negative, and Japan potentially may become negative and deepen as well. So we can unpack each of those separately.
Let's go now to the United States and their liquidity. What are you seeing there? And it almost feels like it's going to be opposite of China.
Yeah, absolutely. So clearly, our liquidity cycle has been negative for quite a while now. It's no secret to anyone. Fed's obviously doing quantitative tightening. Clearly we have an issue in the banking sector as it relates to extending credit. Certainly not extending credit nearly at the pace that we had been in recent quarters. And so that's likely to get worse in our view for a couple of reasons. One, we have clearly the rebuild of the TGA. We've talked about this months ago, so it's no secret. I think it's pretty consensus now. That's draining liquidity at the margins because we have not seen the decline in the reverse repo facility balance fully offset the rise in the TGA. Treasury Secretary Yellen, which is something we've talked about maybe a month or two ago on the program, it did a good job of kind of concentrating T-bill issuance, kind of really, hitting the market heavy and hard with T-bill issuance, a very short-dated T-bill issuance, to kind of drain a lot of funds out of the Fed's reverse repo facility program and transition those into the TGA. So that's obviously offset the rise and the potential drain in liquidity that we've seen in terms of the rise of the TGA post-debt ceiling. That process is not being fully offset. So at the margins, you're seeing a little bit of decline in liquidity in the U.S. But what I think is the bigger issue and the more structural issue is the fact that we're running with these sort of record non-war, non-recession budget deficits in the U.S. economy. We are currently tracking at minus 8% of GDP as it relates to our budget deficit as a percent of nominal GDP. This is the most recent month, is May, that we have the data for. And so what that ultimately means is that they're going to be issuing a lot of debt regardless. And the reason we bring this up is because the Fed has been doing quantitative tightening on autopilot in recent months. To recall that we hit the debt ceiling in mid-January and really haven't issued net debt on a net basis since then. And so the return of Uncle Sam to international capital markets is likely to coincide with a significant uptick in coupon issuance from effectively net zero to something that's a lot greater than net zero in the context of this structural deep negative budget deficit. So this is, in our opinion, it's going to give quantitative tightening its teeth back as it relates to potentially draining bank reserves again, which is something quantitative tightening has not done since the beginning of the year, the very, kind of middle of January. So this is something we're calling out as potential, as a very likely negative impulse on global liquidity in the coming months.
Let's jump back over to the Eurozone. Obviously, the liquidity there, they kind of seem to be doing their own thing to some degree. But what are you seeing on that front?
Yeah, so last week was a big week, right? We got the Fed on Wednesday, the Eurozone on Thursday, China on Thursday, and then the PBOC on Thursday, and then obviously the Bank of Japan on Friday. So as it relates to the Eurozone, we got a lot of important updates as it relates to their liquidity cycle. Obviously, they hiked interest rates. Madame Lagarde was extremely hawkish with respect to the guidance, which allowed terminal policy rates, with respect to ECB to back up pretty meaningfully week over week last week. And so, the ECB is doing a good job of kind of pushing through tighter interest rate expectations through the kind of global financial system. But one thing that's also they called out last week is that, we got 477 billion euro, so over $500 billion of pandemic related financing for banks that's going to mature next month, that they're not going to roll over. So we know the ECB's balance sheet is going to decline by roughly $500 billion next month. But we also have them no longer reinvesting the proceeds from their asset purchase program, which is about $3 trillion thereabouts. And so that's, it's not quite QT, but it's certainly that balance sheet runoff is going to be kind of negative from the perspective of global liquidity out of the Eurozone. So it's very likely that this kind of very modest, we're more or less flat, this very modest kind of positive trailing 3-month impulse in Eurozone liquidity is likely to go negative and get potentially very negative in the coming months, particularly around this summer.
Can you talk about Japan? You mentioned them earlier. What's going on with their liquidity?
Yeah, absolutely. So Japan is a kind of an interesting wild card, right? So the Bank of Japan stood pat on its yield curve control program last Friday. Governor Ueda continues to kind of anchor on wages as opposed to inflation as what's really driving that process. But we also know that if you look at their forecast for inflation in Japan, particularly for the current fiscal year, they're down at 1.8%. Whereas, if you look at where core CPI is tracking in Japan now, it's about 200 basis points higher than that. And so we know that when we get to July, which is when they're going to publish their updated version of, their summary of economic projections, the Japan's version of that, it's very likely they have a significant positive revision to their inflation forecast. Now, if that significant positive revision to the current fiscal year inflation forecast is married by a meaningful positive revision in the out year inflation forecast, it's very likely that they're going to have to start, talking about, or at the bare minimum, tweaking yield curve control again. I don't know if that we know enough that they're going to do it in July, but it's certainly something that could potentially happen in the coming months. Maybe it happens in September thereabouts, as it relates to potentially kind of changing that program. And why that's relevant for global liquidity is because if Japan alters its yield curve control program, it reduces the amount of pressure that the Bank of Japan will have in terms of defending the yield peg in Japanese bond market and ultimately in the global bond market. So this is something that, you go back to kind of the fall of last year into the early part of this year, the defense of that peg was one of the things that really caused global liquidity to really spike higher, from Q4 to Q1 of this year. Right. And so ultimately, if we don't have that kind of market speculation, because the peg is more, I guess, in line with global sovereign debt yields, then ultimately you might see Japan's liquidity impulse kind of get incrementally negative in the coming months. So, when you sum it all up, you have Chinese liquidity is going to be improving. We pretty much know I wouldn't say there's no certainty in financial markets, but there's a reasonable degree of a reasonably high probability that liquidity in the U.S. gets worse from here in the coming months. The liquidity in the Eurozone gets worse from here in the coming months. And there's a strong possibility that Japanese liquidity may get worse in the coming months. And so when you add up what's happening in the US and the Eurozone alone, it's likely to offset what we're likely to experience in China. But when you layer on Japan, which is obviously a very large economy in and of its own right, that may actually kind of make that offsetting process a little bit worse and may potentially cause, some volatility in asset markets this summer, which has been our baseline view. I don't think this is the end of the kind of bull run that we've seen really since the fall of last year, because ultimately we still think the average investor is very much offsides with respect to the timing of recession. We've been you and I have been talking about this for a long time now, but we have been since the last summer of the view that a recession, if it was going to commence in the U.S. economy, that Q4 of 2023 was the highest probability outcome. With the second highest probability outcome of a recession starting in the U.S. economy is Q1 of next year. And the reason that's important as it relates to understanding the market cycle is that asset markets tend to squeeze very aggressively into the end of the business cycle. The median return on the S&P 500, if you go back and look at the 12 recessions, post-war recessions that we have, The median return to the S&P 500 in the year leading up to the peak and around the recession is plus 16%, with an interquartile range of 14 to 20%, plus 20, 14 to plus 20%. There are no non-double-digit numbers in that entire 12 cycle sample. So this is with that understanding, we understand that if we're right on the timing of recession being Q4 or Q1, we could see markets rallying to, I don't know, October or even January between now and then. So ultimately, we do believe this correction will be bought this summer. If we're right on the liquidity cycle, we're right that we get a correction as a function of the deep, then kind of adverse liquidity cycle developments. And ultimately, you probably want to buy a dip heading into year end, or maybe even to year Q4 year end, because ultimately we're not quite ready for that recession phase 2 credit cycle downturn.
So when you start looking at that recession, it's kind of like the most telegraphed recession of all time, right? In terms of like everyone's talking about, everyone's waiting for the shoe to drop, whatever. Is there a scenario where it couldn't happen? What would have to be the kind of inputs into that situation where, as of right now, we think it's going to happen, but what could change that then gets us in a situation where we avoid a recession?
Yeah, no, it's not that what could change. It's that what could continue to go right. So, we've identified sort of 5 things that have really contributed to the resiliency of the U.S. economy. And as a function of that, the resiliency of the U.S. inflation cycle, which has caused obviously a lot more tightening by the Fed since we initially outlined the call back, I want to say it was August of last year. And so ultimately, those 2 of those things are, record cash on corporate and near record cash record cash on household and corporate balance sheets in the U.S. If you look at cash, checkable deposits as a share of total assets in the U.S. for the household sector and the corporate sector is right around, 3% for each. We haven't seen this high of a ratio of cash relative to total assets for both parties since going back to the kind of mid to late 1960s. So that's kind of what step 1. Step 2, you've seen a lot of monetary policy tightening through the lens of the policy rate, and ultimately that's caused a backup in bond yields and whatnot. But the reality is, it's just harder for that stuff to really impact the economy. These long and variable lags may have gotten longer in the context of how much sort of low cost fixed rate debt we have in the U.S. economy right now. With data through, I want to say Q1 of this year, the effective mortgage rate on the total stock of mortgage debt in the U.S. economy is still down at 3.55%. Obviously, the marginal mortgage rate, if you're in the market to buy a house, is north of 7%. But most people aren't trading their 3.5% mortgages for 7% mortgages. So it's not the monetary policy impact of that really is muted because no one's really moving as a function of that. And so that's kind of step 3. Step 4 is reason number 4 is we've seen a significant decline in manufacturing as a share of both the labor market and as a share of GDP. We used to be, I want to say, somewhere around 45% in the 40s in terms of manufacturing as a share of total employment. Now we're down at 14%. Manufacturing as a share of GDP is only 18%. And the reason this is important is because manufacturing, if you look at the net job loss that we experience in recessions, manufacturing on a median basis, since going back to all the post-war recessions we have data for, manufacturing on a median basis accounts for 98% of the net job loss we tend to see in recession. So that tells you that, hey, this is the cyclical sector of the economy. If it has declined as a share of total employment and share of GDP, obviously you need to have a much more significant downturn in the manufacturing sector in the U.S. economy to actually affect a real recession across the broader services-dominated U.S. economy. And so the final reason, number 5, is we've seen a significant amount of labor hoarding in this cycle. If you sort of look at the delta between the current level of this current size of the total labor force here in the U.S. relative to the pre-COVID or the post-GFC trends, we're right around 5 to 6 million workers shy of that trend line. So, but what's not shy of the trend line has been the recovery in gross domestic incomes. We're north of that trend line, and so we've seen a significant recovery in income, particularly for U.S. businesses, but we have not seen a significant recovery in labor supply. And this is as a function of that, you're seeing a very tight labor market that's been extremely resilient to Fed tightening. And part of the reason for that, being extremely resilient to Fed tightening is the fact companies may just be reluctant to fire people in this particular cycle. They may have to see a significant, much larger kind of a hit to their profitability and outlook for their profitability before they feel comfortable firing people, because they know that in the next business cycle, it's going to be very difficult to find and retain talent, train, and retain talent. So this is something that's kind of delaying the process as well.
Darius, I learn something every time we talk. Where can we send people to find you on the internet or find out more about 42 Macro?
I appreciate you, man. So definitely come check us out at 42macro.com. Obviously put, research out for all top institutions, asset managers, central banks, et cetera, across the global economy. We make that same research available to retail investors at the same price point, very, very low price points, because we ultimately believe that knowledge is power. And we want to help as many people as we can. So check us out at 42 Macro. And then follow us on Twitter as well. My public Twitter is 42 Macro Weather. We have a private Twitter account as well for our subscribers and our members. So I spend most of my time in that private account, but we definitely do publish our public account as well.
Awesome. I appreciate it. And we'll definitely do it again in a couple of weeks.
Absolutely, brother. It's great to see you guys. Cheers.